All right, so I'm going to cover the weekend report, the daily report, and then there's a couple pieces on the daily report I want to look at as a way to calibrate our estimate of what's available for trades on swing basis by taking a look at the holding X number of days report. I got to come up with a better name for that. The holding X number of days report from the daily. So we'll take a look at silver on that one and see what we can see. Let's see here. All right, so we're getting started now with the weekend report for January 28th, 2012. And we have a market that is in bullish, quiet conditions, very favorable. We're at 59 on weekly RSI, so that looks basically at an annual basis, weekly RSI. The short term, using the 10-day NDX, we're at 72, right in the middle of neutral. We had a bit of a pullback on Friday. Long-term trend with respect to the 200-day moving average is at 5.69%. That's bullish. It's in the white, so it's been stronger than that in the last 180 days, but still it's good to see that we're out of the sideways. The 5-day slope of the 50-day moving average at 0.61% is bullish because it's greater than zero, and it's in the green, meaning it's as strong. It's in the top 15% of upward slopes of the past 6 months, so that's positive. ADX has improved up to 25. It just that's the threshold for becoming a strong upward trend. We've watched that grow from under 10 and in this run up over the last about 3 weeks. It's gone from under 10 and it's pure sideways to a strong young bull. ATR percentage is quiet at 1.01%. And so when you take a look at the aggregate of the indicators, we have all systems go for an upward moving market. And I feel pretty good that our indicators have allowed us to adapt to that new state of affairs systematically over the last 3-4 weeks. So we have a bull quiet market, neutral on a short-term basis. We will be doing the blended monthly rebalancing this week, depending on which flavor that you're using. The 26 ETF portfolio, if it were to execute right now, would still be TLT, diamonds. No, I'm sorry, that's not right. This is the holdings right now. TLT, diamonds, and energy for the 26. Then TLT, diamonds, and U.S. real estate for the 13 ETF. What I should say is that the holding period, I mean the holdings, if you executed it now, would actually change for the 26 ETF. We'll take a look at that next. Come on, mouse. Where are you? There we go. Yeah, so in both the 13 and the 26 ETF, the 3 top holders are TLT, IYR, and diamonds. So that's the long bond, U.S. real estate, and diamonds. And then in the 26 ETF portfolio, it's the same 3 suspects again. And again, these are based on a sort using this blended strength ratio. So if we executed today, TLT, IYR, and DIA. So still a U.S.-centric condition. You'll notice that if those are the winners, then it's the globals that are at the bottom of the heap. And what I do like is that Latin America and Brazil are continuing to lead the way north for the internationals. China is in there too. And that's where the strength is. So the strength in the globals is in emerging markets, China, Latin America, and not Europe. We'll move on to the health check next. And so what we have again is the vertical blue lines represent 10, 20, and 30-day look-back periods in the market. The horizontal purple line at 137 still represents the, really it's the highest high of the last 12 months. That's put the upper limit on our trading range of the last year at 137. And so we're still in this trading range between 107 and 137. And as you can see, we're at the, in the upper quarter of that area right now. The solid red lines represent support levels that have held in times past. You can see where each of these support levels is on my marking. What I like is that that's been basically following that 10-day moving average, which is the solid green line. That's the rising support levels, and that's indicative of generally bullish conditions. The solid black line in the middle here is the 30-day regression line, and then the outer black lines represent the RAF regression channel, or the maximum excursion from the regression line during that 30-day look-back period, which right now occurred, on December 19th was the last low. And then since that time, the width of that channel has narrowed, and the slope has gotten very strong, and the R-squared coefficient right now is high. It's about 0.9, which says that regression line is a very good descriptor of the price action. You can see there's very little variation away from that line. We've been overbought for almost 20 plus days, so 4 trading weeks. The PPO, which is the price performance oscillator, which is like a MACD histogram, but it uses percents rather than dollars, has been grinding upward. It's hard for that indicator to get much better than it is right now. If there's any kind of sideways movement here, which would be consistent with resistance at 130, it's about 135. If we get resistance right here in these dotted purple lines, and price starts going sideways, then we would see this oscillator start to decline, and then some folks would treat that as an intermediate signal that the bull is temporarily pausing. In my view, as long as we stay above this 124 level, which is the 200-day moving average, and the 50, which just crossed, we're going to be in good shape. So I see the short-term trading range to be between 124 and 137. We're right about smack dab in the middle of that. This iron cross happened this week where the 50 crosses above the 200, and so now with price above the 10, which is above the 50, which is above the 200, and with the ADX, as you can see, at plus 25 with the bulls in charge, this is kind of the official awakening of the bull market right here. Now, we've been in bull quiet really since about the 1st of January. So we had almost 3 weeks of early warning as prices just continued to march right up this regression line. You can see finally the slope indicator or the lowest indicator has improved. It got markedly better on the 17th of January here, and still continuing to go up. That's very favorable. So all systems go. Market is a young bull. We'll see how much endurance it has. The next thing that has to happen is for this really to be confirmed bull to me is it's got to stay above this 124 price level. It's got to go up and test 137 and get through that. If we see a close above 137, then there will be that will be very positive sign of good things to come. Until it gets through 137, we're simply at the top of what's been a 12-month trading range, and then we would expect to see more intermediate swing trading opportunities. If it gets through 137, all your long-term buy and hold systems should be working really well. Certainly things like 551W and triple screen and channeling will be favored under those conditions. Okay, moving on. Looking at the ETF2 database right now, we have all 10 of the regional ETFs are on buy signals based on that 4-month moving average filter. The strength is all in the U.S. They're all in the white, as you can see, and then the globals are all in the yellow or yellow and red, depending whether you're looking at average or the strength rating. This week, we're at 100% exposed because of the all 10 symbols being on a buy. We have, let's see, SPY is better than EFA. This is really inverted right here. This should read the NASDAQ at 64 is better than SPY at 63. And weakest areas, IEV and EWJ still. Moving on. Now taking a look at the Tortoise World Market Model, which uses that strength reading, the blended strength reading to assess the world. You can see inside the U.S. everything is above average. The small cap value at 79 is in the green. Treasuries remain strong. Silver and gold have both made comebacks the past 10 days too. We'll take a look at silver a little bit later. Europe generally suffering. Asia having a mixed bag with some leadership in Malaysia, Hong Kong. But the real strength in the emerging markets is coming out of Latin America and Brazil. Interestingly, the industrials and technology and discretionary are leading the way. So once again, it's that stealth risk on trade is starting to work. We've seen over the last 6 months that what was dominating were the defensive plays, the staples, utilities, and healthcare. And now, however, it's industrials, materials, and consumer discretionary. They're starting to lead the way. So that's favorable for the bull market narrative. Okay, moving on. Taking a look at the top performers on the ETF 30 database, biotechnology near the top. I'm not gonna highlight the bonds, but we got U.S. mid-cap value, pharmaceuticals, building and construction. Small caps are very dominant, especially the value. IJS, I think, is a very good way to play that one. Regional banks, industrials, high yields, small cap. Small cap earnings means with basically dividend payers, industrials, XLI, in equal weight industrial. So you can see right now that we've got almost 50% of this top group here are all equities, and they're all starting to favor the early stages of the business cycle, which is industrials, technology, things of that nature. And things that are paying a dividend are still favored. And I like that the small caps and the mid caps are doing well, because that tends to support the growth on story, that narrative as well. So that looks pretty favorable. Looking at the Dow 30 and using the same methodology of average, strength, consistency, and quality. And this one is sorted by the strength column. So we're looking at Home Depot, Caterpillar, Merck, Intel, Cisco, Pfizer, Kraft as the winners. The losers being lots of banks here: American Express, Bank of America. Alcoa has been a very good trade for me, and we're going to take a look at that chart a little bit later. But it got hammered so badly that it's got a long way to catch up, which makes it perfect for value players such as myself. Interesting to note, all of the Dow 30 are on a buy signal with respect to their 4-month moving average. So the U.S. has been experiencing flight to quality in my judgment, and I think we're starting to see that shift over now into the risk-on trades. All right, next up, I want to shift over to the daily report. So I'm going to get that queued up for you here. Okay, I'm not going to cover the top ribbon again, so we'll just get right into the other indicators. Taking a look at the gap stat, let's see what we can see. Taking a look at the last 30 days. The market has gapped down 13 times in the last 30 days. Now, interestingly, 12 of those 13 times after it gapped down, it reversed and went back up. So what has really been working is the morning hook strategy, which again looks, if this was yesterday's close and it gaps down, it's been a sell-off, and then it reverses and goes higher. That is the classic morning hook. 17 times the market has gapped up. 10 of those times the gap up has reversed. 7 times the gap up has continued to gain. So really, regardless of where it has opened, 19 times out of 30 the market has closed higher. So 2/3 of the time the market's been closing higher. Well, we know that because it's been a grinding bull upward. However, what I really like is the fact what's been working really well for me the last 3 weeks has been this gap down and reverse up, i.e. the morning hook. So my favored system is working. No signals in overreaction or in the channeling rules. You can see the daily pivots. You can see the 10-day NDX has been overbought for at least the last 10 days, and just on Friday dipped down into not overbought. So it's still in the upper range of the 10-day trading range. However, it's not quite overbought anymore. You can see volatility has declined, continues to decline dramatically. Although right at this 1% level, to me it looks like it's that's extraordinarily quiet compared to where it was back in August. You can see we're almost 2 standard 2 full standard deviations from average. The average of the last 6 months has been about 2.1, and we are at half of what the average volatility of the last 6 months has been. So part of me says, yeah, it's quiet, yeah, too quiet. So we're going to look at some cautionary analysis when we look at silver and Alcoa here after we get through the daily. Taking a look at the 10-day min pain, and these are the ones that have lost the least from their 10-day high. Johnson & Johnson, 3M, Intel, IBM, and General Electric. Gold among the ETFs is of interest. 10-day max pain, these are the ones that are the furthest away from their 10-day high on a percentage basis for each of their populations. In the Dow, it's Travelers, Verizon, AT&T, Chevron, and Hewlett-Packard. Among the ETF 100, it's the VIX, the dollar up, regional banks, and U.S. Treasuries. Taking a look at short-term setups, we have a 5-day down in Verizon, 551W in AXP, and a triple screen in Merck. Channeling signals galore. Verizon, Travelers, McDonald's, excuse me. McDonald's is one that we ought to pay attention to because that's been such a strength leader. Pfizer, AT&T, Procter & Gamble, Chevron. So lots of good channeling. Those should be high priority trade frames for you because of the powerful bull quiet move that we've been describing earlier today. Inside the auto framer, the ones that I'm underscoring here, McDonald's, the VIX, Verizon, Travelers, Pfizer, Chevron, long-term treasuries, all of these here. These all have a greater than 2-to-1 reward to risk ratio if we just did a trade frame with the 10-day high as the profit target and then bought 5 cents above Friday's high and used Friday's low minus a nickel as the a range risk. So all of those frame out at 2-to-1. So maybe we'll take a look at McDonald's when we get to it, and maybe Pfizer. I like McDonald's and Pfizer because they're both channeling signals. So we'll take a look at those and frame those trades. Okay, moving on. Looking at the Dow tactical summary here. And again, you can see all the, there's a lot of dojis in play and a ton of good channeling signals that we looked at before. Verizon, Microsoft, Pfizer, Chevron, and Travelers. We have Merck again on the triple screen. You can see the max pain range compression candidates 1 through 5. And those also happen to be the ones that look really good on the auto framer for reward to risk ratios. And that's why I say we'll take a look at McDonald's and Pfizer as 2 exemplars of things that are on. They have a powerful channeling signal setup. They are max pain range compression. They test out favorably on the auto framer. You can see that they're related to that, what they've lost in the last 10 days. If you're a top feeder, if you're looking at the 10 days, then you're looking at these things down here. Bank of America, IBM, Intel, Caterpillar, JP Morgan. I'm going to look at Alcoa no matter what, just because it's one of my trading favorites. But you can see I think Alcoa has started to turn it around. On the 3, 6, and 12-month scores, it tests out in the red. But on the shorter term, from 1 month and closer, it's actually doing very well. And I think that's consistent with what we saw, that the industrials are doing better. And now you can take a look at Caterpillar, which is in even better shape than Alcoa. You know, Caterpillar, really from the 3-month all the way out to 3 days, has been excellent. It's coated in the green, meaning it's an exceptional performance leader among the Dow 30. It looks like it could almost be the strongest one out of the whole deck. So that's pretty cool. You may recall about this time last year, Caterpillar went off on a really strong run that lasted all the way up into the beginning of summer. We got up as high as, I think, about 120. Okay, so moving on. Among the ETFs, not as many things to choose from. You have a couple dojis in oil and diamonds. We have a 551 pattern in oil. It is also number 5 on the max pain range compression. And we have 2 auto framer candidates that test out at favorable reward to risk, and that's VIX and the TLT. So we'll take a look at the VIX as well, just as a contrarian position, because we're in bull quiet conditions. Everything should keep going up until otherwise noticed. But in my view, when things get exceptionally quiet like this, that first counter move away from that can be a heck of a big red candle. And so the VIX and TLT should both do well if we get one of those one-day downward spikes. So we'll be prepared for that. All right, moving on. Taking a look at the frog quality numbers. You can see there's still quite a few that are above the 3.0 threshold. So Johnson & Johnson, Intel, American Express, Pfizer, I like. I like U.S. real estate. That's one of those blended monthly rebalancing holdings, so that's not bad. And so on Pfizer, what we're looking at has a standard deviation of 8 cents. How very interesting. And his range stat is 35 cents. So it can move 35 cents in a day without us being entitled to being surprised. And its standard deviation, its frog number, is 0.08. Very good. Okay, moving on. Signal to noise ratio, just a couple to highlight in here. ILF has been exceptionally directional during the day. Like the green 50.55 means that 55% of its daily move has been directional. So on average, its daily candle is more, the real body on its daily candles have been more than 50% of the daily range. So it has directional days. And you can see Brazil and silver, a couple of trading favorites of mine, are also very near the top of that. So I like the looks of that. I think that's consistent with what we've seen in strength coming in sneaking back into the emerging markets with Latin America and Brazil. You can see at the bottom of the chart, Johnson & Johnson, for example, with a signal-to-noise ratio of 0.35 means only 1/3 of its daily range is real body. So it has long tails, a lot of intraday volatility, whereas the ones at the top are more than 50% real body. So you should know these things about your about the candidates that you're stalking. It will help you with your intraday trading. The fail stat has been an important report for me in the past 3 or 4 weeks because of that morning hook strategy that we looked at when we looked at the gap stat. Remember, 12 out of the 13 times that it has gapped down in the last 30 days, the market has reversed to close higher. So here's just a little example of that. If it closed here and then gapped down a certain distance, 12 out of 13 times, the market has, after it has sold off, has reversed to close higher than where it opened. And so that's the perfect example of the morning hook. So if that's been the case, what we're really interested in knowing with the fail stat is how far has it typically been selling off from the open to what became the low of the day. So if we take the average of that, let's just consider, oh, let me get, let me find one that we're going to look at anyway, and that's going to be, I guess, Pfizer. Pfizer has sold off 27 cents. No, that's not right. The fail average is what I'm looking for here. Excuse me. So when we look at Pfizer, right here, we come over. Pfizer has been selling off 16 cents on average before reversing to go higher. So that's going to be interesting for us to know. We saw Pfizer had a standard deviation of only 8 cents. So one of the things we can consider then is if Pfizer gaps lower and then sells off 10 or 20 cents and then seems to be finding support and then starting to reverse, as soon as it moves 8 or 10 cents off that low of the day, we should be prepared to buy it, provided the market's also doing the same behaviors. We would like to see the market going up. So if that represents about 10 cents, a brick of 10 cents, we know from its frog quality number that it can move almost 4 standard deviations higher, meaning that we give up 1 unit of noise and we can still get a 3-to-1 reward to risk ratio. And that's without any particular pattern. That's just looking at price action and the averages of the last 30 days of its price behavior. So that's going to be an important concept for us when I look at Pfizer tomorrow. Okay, moving on. Right, we're taking a look at some of the additional market mosaic charts. And what we have is the regression line with an R-squared coefficient of 0.92, which says, dude, this is an upward bull. Now, what's interesting though is that it's pulled back now to its 10-day moving average. It's had 2 good long runs up. It is more than 1 standard deviation above its average line, and all that tells me is that it has already had a pretty good move. And if you take a look at the last 180 days, you can see it's had almost a 2 standard deviation move up, and 2 standard deviation moves up are what its norm has been over the last 180 days. So if ever there was a time for a natural pause, this would be one of those. Now, if we also look at the percent stretch with respect to the 200-day moving average, you can also see that we've got a couple pretty good moves have already been put in. But those are like 2 standard deviation moves already, and it's starting to roll over at this level, 1 standard deviation above the average of the last 180 days. So to me, it would not be surprising for that 137 to still be in resistance, and for the market to have to take a couple runs at that before it blasts through there. Now, if it fails at this price level, what this is telling us to come back to average is really about a 5 to 7% pullback. That would take it back to the 200-day moving average, where if it found support, we would still certainly be in. We'd still be in a bull market. That would be normal backing and filling. So I'm very interested in buying dips, and I want to see evidence of price action resuming the upward trend before I get back in. So I'm taking a measured approach to buying dips in this bull quiet market.
Mm-hmm.
To me, the perfect candidates for those kinds of moves are things that are already in the channeling, the channeling pattern. Those are things that have moved up, have pulled back, and then are prepared to hook up and go. So that's the moment that I'm looking for. I want to wait to see that price action resume before I buy it. I want to be a second mouse, and so that's where the trade frame comes in. We'll take a look at that when we look at Pfizer. Okay, moving on. Oh, I'm sorry, Lisa had a question here. Last week I called those one-day opportunities. If they are only one-day opportunities, why use the 10-day high for the 2-to-1? Well, because what I'm looking for is a retest. I look for a standard profit target no matter where I am in the market cycle. To me, the 10-day high represents a reasonable recent price level that people are hoping to gain, and the one-day opportunities to me still. We could see the VIX and all those channeling targets make that move back to the 10-day high in a single day's worth of price movement. You know, when you look at the range stat, you look at the maximum one-day percent gain over the last 180 days. All of those 10-day highs are within reach on a single day of price action. We'll see that when we look at silver. The kinds of moves it can make intraday. So for me, the 10-day high is simply just a standard rule of thumb that I use for estimating upward price action. Okay, moving on. Oh, this is the last chart I want to show off the daily. Is this one? This is like this is page 9 of the daily. If you're looking at the weekend report, it's like the bundle. It's like slide 40 out of 47. And I offered you a little quiz, and I said if you take a look at the well, let's take a look at the 20-day holding period and really the 10-day holding period. Now, if I already owned positions in these symbols, which ones would I be, where would I want to make sure that I preserve my profits? So I want to take a look at silver. Okay. And when we look at the 20-day holding period, as of today, if you had bought silver 20 days ago and held it till today, you are up 21.76%, which is a pretty good move. Now, the single highest score, the maximum score that it's had in the last 5 years was almost 30%. So the best you could have ever done in a 20-day period in the last 5 years in silver was about 30%. And right now, we're holding 21.75%. That's what it's covered in the last 20 days. Well, the standard deviation of the last 5 years is 11.17%, which means that we have a Z-score of 1.74. What that means is the 21.75% gain in silver has already gone past the normal expected range, which is plus or minus 1 standard deviation. All right, so a normal move in silver over the last 5 years for 20 days was somewhere between plus 13.5 or minus almost 9%. Because we're at plus 21%, what I want you to see is that we're closer to 2 standard deviations above. That is, you could classify that as an exceptional move in silver already. And so in my view, if you already own that position, you want to make sure that you are preserving profits in those positions that have already earned above and beyond the normal expectation. For me, the normal expectation is plus or minus 1 standard deviation from the average. So as soon as silver went past 13.5% for the 20-day holding period, time to start making sure that you don't give that profit back. So as a quick estimate of what is overheated and underheated, you can take a look at the Z-score and see which ones are above 1.0. So among the big indexes, it's Japan, Latin America, emerging markets, and silver, gold, and Alcoa, however, are the real exceptional winners. And so those are the ones that I really want to preserve my profits in. Now, if your holding period is typically less than 20 days, you might want to look at the 10-day or the 5-day. So in silver, we're at 0.76 on a Z-score. It has gained 5%, and so it's still, the last 5 days have not been extraordinary, but they've been steady. But when you start adding 20 days in a row of upward movement after a 20-day holding period, silver is kind of remarkable. So that's how I use this particular report, and that is, what is a reasonable expectation for what this thing can do when it outperforms, and at what point should I start thinking about it as an exceptional move? And it's based on the rolling last 5 years of trading data for the symbols. And for each one of those holding periods, 40, 20, 10, and 5 days, it finds the maximum percent gained, the maximum percent lost, the average, the standard deviation, and then builds this range of normal between plus and minus 1 standard deviation. And that gives me a quick way to estimate where we are in the holding periods. Okay. So with that in mind, I want to stop here on the daily and then just go right ahead to the to take a look at some charts. And there were 4 I wanted to look at. Okay, so we're just taking a look at silver here. There we go. And if you take a look in the transcripts in the chat room, around the 27th of December, we said, hey, wow, silver has broken through this, what had been a really strong support level at 30, and it had this big, huge down day, which left it like 2.5 standard deviations away from the median. All right, each of these little shaded regions represents a half a standard deviation, which you can tell over here on the chart, right? We have the median, which is that dotted line. Then the first boundary is plus or minus 1 standard deviation, and then it's 1.5, 2, 2.5, and 3. On the downside, it's minus 1, minus 1.5, minus 2, minus 2.5, and minus 3. So when it closed down here on I think this is probably on either 27th or 28th of December, we said, hey, exceptional down day, left it at an extreme. The next morning was a big gap down, and then this one-day extraordinary move from 25.5 to 27.5. That's a 10% move in a day. And then what we've seen is these counter trend rallies. I basically aim for the let's see here. When moves come from these extremes, I always target them to come back and test the median and then see what happens. So I see that as the first leg up, and then what you get is the sideways movement for about 5 days, and then instead of failing, if it were to continue that downward slide, which had brought it to that low, it would have reversed here and then pulled back down and then tested the swing low. And then failure below that would have been, horrible news for silver. But it didn't do that. Instead, what it did was it broke out and then started marching up. And now this little pullback here is crucial. Because out of this sideways movement at the median, what you got was one up, one down, and then it started going up again. This is a huge buy signal for me, with a stop down here below the median, and then aiming for a couple 2 or 3 standard deviation moves up. So whatever this first move was off the bottom, I look for another one that size, and sure enough, that's what we get. Into the next congestion zone, and then another universal entry and go. So what I like about this this array with the Bollinger Bands, using 30-period look back, it's slower to react than the traditional 20-period Bollinger Bands, which is fine. It doesn't bother me to look at the market in different ways. What I like is what I call the Bollinger Band pinch. You can see how it got very wide because of the volatility, and then it crossed over, and then it will ride the fast lane, and it will leave that dotted line behind, and so now this is the upward trend. So that's the really powerful move in silver. Now, if you waited this long to get into silver, it's already plus 21%, as we saw from the last holding X period chart. That's an exceptional move. That's 1.76 standard deviations, right, for a 20-day holding period. So that's an exceptional move compared to the last 5 years. So that's a move that I want to preserve. It's not a move that I'm just going to hurry up and try to get on board and chase it. Why? Because I think the train already left the station, and the easy money, which is hard at the time, the easy money which got in around here or bought the extreme for a tactical trade, is already looking to preserve profits. So when I take a look at this rascal now, I still own silver, but I want to make sure that I would have my stop in here to preserve the entries I was making down in here. I do not want to give back. I don't want any of those, trade 1, trade 2, and trade 3. I don't want any of those ever to go negative. That would hurt my feelings. So I've got my stop up under here, which is about $2 on 30, so about a 6% stop. Now, I'm willing to buy more on a tactical trade, but that is a very tactical trade. I don't stick around too long for that. What I do like is that it has cleared this 32.5 support level or resistance level. Now there's an opportunity for it to go. But to me, that's I should be preserving that move. Now, Alcoa was another one of my favorite trades that was also had a high Z-score over the last 20 days. So we'll take a look at Alcoa real quick here. Almost the same kind of chart. Had that double bottom around 8.5. Anytime Alcoa is under 10, I'm an aggressive buyer of it on tactical trades. I like this. I like this move right here because it had a gap up. It went up and got through the median, came back and held support at the dotted line, and now you can see the Bollinger Band pinch happening. You can see higher lows, and now it's going to ride this thing all the way up. So I like that lazy W. I like this little lazy W right here, and that's the price action that I'm looking for inside that circle. That pattern right there is very powerful, and with a stop under the median and buying here, you can see this is already probably 1, 2, 3, 3 are in hand. And now what I want to make sure is, now that the trend is up, the downward target is a return back to the median. So if it fails at this 10.6, the target move down comes to here. So I don't want to give all of that back, so that's why my stop is going to be right around 10.2, and I can preserve this little piece of price action, that profit right there. So that's Alcoa. That's another one that was overbought. So now I want to take a look at, I think we said Pfizer, and see what kind of channeling action we have available. This could be interesting. Now what we have in Pfizer is this sideways quiet channel developing, and it's at the bottom end of its 10-day trading range. The trading range is not very large, but the fact that it has failed to fail is good. The downside is that this is actually lower relative strength than the S&P. The S&P has been going up during this time, but Pfizer has only been going sideways. I think part of that is the Pfizer was an early leader, and then money started shifting from the defensive plays, which have been working, and now we're cycling over into industrials. And I think because of the recognition and the strength of Pfizer in healthcare, we didn't see a failure and come back to test 18. It's been holding here. So tentatively, if I see a universal entry, I would be willing to go with Pfizer with a very tight stop, and then play that on a one-day basis and see how it goes. I think McDonald's was another one that looked interesting. So let's see what we can do with McDonald's. This is also a channeling pattern, but there's a different psychology in here. We've already seen 1, 2 sell days. Now McDonald's had been the strongest member of the Dow for a long period of time, for almost a 6-month period. And on this profit taking, when it hit 101.5 or 101, one big day of selling, 3 days of grinding up, couldn't make a new high here, sold off, grinding up with little dojis, and then 2 days of sharp selling, and now it's found support at 96. So it's at the bottom of this little sideways channel, and the volatility is actually greater here. There is more nervousness in McDonald's than there was in Pfizer. Well, that very nervousness is what makes the channeling system potentially excellent. And so if we just look at this on a trade frame basis, you can see that the 10-day high is up about here. Here's the trading range. And you can see, because Friday was a little tiny doji, that if we can buy it at 99 on momentum with a stop at 98, we have almost a 3-to-1 reward to risk ratio using the channeling system for McDonald's. And getting back up to 102 wouldn't surprise us. Now, if it goes through 102, it will have cleared the resistance overhead, and this powerful previous winter is going to look good. A little bit troublesome here is the fact that we've got ADX declining and now the bears are in charge. So this is one I don't have any strong belief in this. The fact that it's losing, I see this as losing steam. You can see that the slope of the 30-period Bollinger Band median has started to flatten out. This is a natural place for it. If it fails, it'll come back and test 95 next. So I don't normally like to short relative strength winners, but for me, the reason I would respect that stop at 98 is because the next place that there was any kind of congestion was 95, and then if it fails at 95, you're looking for a run back to 91. So the purpose for tactical traders, for swing traders, the purpose of that $1 stop is to protect you from believing too strongly and then suffering a $7 loss, your original one plus another 6. And if your target is just 102, you can't really justify having initial stops this far away, otherwise your reward to risk ratio is all out of whack. So I'm going to wait to see some strength in McDonald's, and then if it starts working, I'll play it at 102. If it gets through 102 and then starts doing this lazy W's, then all of these little support levels become little channeling signals, and this thing could be great. So I've gone a little bit over time, but I wanted to cover a few tactical trading ideas. I want to invite you to look at the in the Campfire chat room. Jim Carroll was kind enough to agree to make a presentation on his version of the blended monthly rebalancing that comes out of our mastermind strategy group, and he's going to show how what his back testing and forward testing results are. He uses it as a money manager for his client money, and he's showing a couple different versions of our basic ideas, and the slide presentation for what he'll cover on Saturday is already in the chat room. So I would invite you to take a look at that. But otherwise, that's everything I have. I'll stick around for a couple of minutes if there's any other questions, but I'm going to go ahead and stop the recording and start processing it now, and I will upload the recording to YouTube, and I'll post the link to that in the chat room. So good trading, and we'll see you in the chat room. Keep your powder dry and your risk measured.